Hi everyone, welcome back to my channel. My name is Rishi, and in this video, we're going to go through a capital structure question based on WACC. WACC is the weighted average cost of capital. It is the average cost of financing for a company. In this question, we're given three different sources of financing, which are equity, debt, and preferred stock. We're given the market values, we're given the risk-free rate, market risk premium, yield to maturity, corporate tax rate, and the preferred stock information. The first thing that we're going to do is write down the equation for WACC. Okay, WACC is simply weighting on equity multiplied with cost of equity plus weighting on debt multiplied with cost of debt, 1 minus tax. Interest is tax deductible, that's why the cost of debt has 1 minus t next to it, plus weighting on preferred stock multiplied by the cost of preferred stock. Okay, that's the formula that we're going to use today. So we have the market values given to us 600 million, 300 million, 100 million. So the total value is 1,000 million. So the weighting on equity is simply going to be 600 divided by 1,000. Weighting on debt is simply going to be 300 divided by 1,000. And weighting on preferred stock is going to be 100 divided by 1,000. So we get the weightings here. Now we got to find the cost. To find the cost of equity, we're going to use the CAPM model, which is risk-free rate plus beta multiplied with the market risk premium. It is a single factor model that is widely used in the industry to calculate the cost of equity. Beta is the sensitivity of a stock to the stock market. So in this case, we have a beta of 1.2. What that basically means is that if the stock market goes up by 1%, our stock goes up by 1.2%. So the risk-free rate is 3%, beta is 1.2, market risk premium is 6%. So we get 10.2%. YTM, now we're going to calculate the cost of debt. YDM is a single discount factor that sets the future value of a bond's cash flow equal to the price today, and which we're going to use to calculate the cost of debt. So we're going to use the cost of debt as 5.5%. However, we're interested in after-tax cost of debt. So after-tax cost of debt is going to be 5.5% multiplied with 1 minus 0.25. Okay, so 5.5 into 0.75. When we do that, we get 4.125%. The cost of preferred stock is going to be the dividend divided by the price of the preferred stock, 4 divided by 50. Based on the geometric sequence formula, we get 8%. Okay, now that we have all the cost and all the weights, we're going to simply use our WACC formula to calculate our final answer. So WACC for this company is going to be 0.6 multiplied with, I'm just going to put it in brackets, make it simple, 0.6 multiplied with 10.2% plus 0.3 multiplied with 4.125%, because we already calculated this part, plus 0.1 multiplied with 8%. Okay, so our final answer would be 0.6 into 10.2. And like you can notice, the cost of equity is greater than the cost of debt because equity holders have a residual claim on a company's assets. 0.3 into 4.125, which is 1.2375. 0.1 into, okay, and we can, okay, this is 0.8%. And summing it up is going to be our final answer. 0.2375, 0.8. Okay, so 8.1575 is the weighted average cost of capital for this company given the information that we provide in the question. Hope you like this video. Short and simple example of how we can calculate WACC. Very common and famous question asked in corporate finance examinations. Please like and subscribe to my channel to see solution of such topics in the future videos. Thank you.